What if the real story in the silver market isn't the price you see on your screen, but the metal quietly disappearing behind the scenes? Physical silver is leaving New York vaults at an accelerating pace, while China continues paying a staggering $9 premium above global benchmark prices. That is not a normal market fluctuation. That is a signal. When inventories decline in a major financial hub and one of the world's largest consumers is willing to pay significantly more to secure supply, it forces us to ask a serious question. Are we witnessing a structural shift in the global silver market? Today, we break down what these movements truly mean for investors, institutions, and the future of physical supply. Something unusual is happening in the silver market, and serious investors are starting to pay attention. Physical silver is leaving New York vaults at an accelerated pace, and that is not a routine fluctuation. New York represents one of the most important global storage and settlement hubs for precious metals, closely tied to futures exchanges and institutional trading activity. When inventories decline sharply from these vaults, it signals that actual metal is being withdrawn, not simply traded on paper. That distinction matters. In commodity markets, there is a fundamental difference between price movement, driven by speculative positioning, and movement driven by physical supply shifts. Vault outflows fall firmly into the second category. When metal exits storage facilities in meaningful volume, it reflects real demand from buyers who want delivery, not exposure. This can include industrial users securing supply, sovereign entities diversifying reserves, or institutional investors reallocating toward tangible assets. Regardless of the buyer profile, the result is the same. Available inventory tightens. Inventory levels in major vaults function as a visible barometer of market liquidity. When those inventories decline faster than historical norms, market participants begin to reassess risk. Lower stockpiles reduce the buffer available to absorb sudden spikes in demand. In tightly balanced markets, even modest disruptions, whether from industrial consumption, investment flows, or logistical constraints, can amplify price sensitivity. It is also important to understand the signaling effect. Rapid outflows may indicate that confidence in paper silver exposure is shifting. Market participants who previously held futures contracts or unallocated positions may now prefer direct physical control. That transition can alter the structure of the market, particularly if physical withdrawal rates exceed replenishment rates over a sustained period. For professional investors, the key issue is not simply that silver is leaving vaults, but why it is leaving and how long that trend can continue. Persistent inventory drawdowns reshape supply expectations, influence forward pricing, and potentially increase volatility. When a major storage hub experiences accelerated depletion, it becomes a data point that cannot be ignored, because physical supply dynamics ultimately anchor the long-term pricing framework of any commodity market. Here is a critical question every serious metals investor should ask. Are we watching the price of silver, or are we watching the availability of silver? The divergence between paper markets and the physical market is becoming increasingly important. Futures contracts, options, and other derivatives create enormous trading volume, but they do not always reflect immediate physical tightness. When physical silver leaves vaults aggressively while futures prices remain relatively stable, it signals that underlying supply-demand conditions may be shifting beneath the surface. Paper silver markets are highly leveraged. A single ounce of physical silver can underpin multiple ounces of contractual exposure through futures and synthetic instruments. This structure works efficiently under normal conditions because most contracts are cash settled or rolled over rather than physically delivered. However, when more participants begin demanding actual delivery instead of rolling contracts forward, the pressure on physical inventories increases. That is when divergence becomes meaningful. The physical market operates on tangible constraints: mined production, recycling flows, transportation logistics, and vault inventories. The paper market, by contrast, is influenced heavily by speculative positioning, hedging strategies, interest rates, and macroeconomic sentiment. Prices in futures exchanges can therefore reflect expectations and momentum rather than immediate physical scarcity. When vault withdrawals accelerate but prices do not immediately react, it suggests that the futures market may not yet be fully pricing in tightening supply conditions. This gap can create risk. If confidence in paper claims weakens and more participants seek conversion into allocated physical metal, liquidity assumptions embedded in the derivatives market may be tested. Historically, commodity markets tend to reprice quickly once physical constraints become undeniable. At that stage, volatility often increases as pricing mechanisms adjust to reflect real-world availability rather than abstract exposure. For institutional participants, monitoring this divergence is not optional. It informs hedging decisions, risk management frameworks, and portfolio allocation strategies. A widening disconnect between paper pricing and physical inventory trends often signals structural change. When the physical market begins to assert dominance over speculative flows, it can alter the balance of power within the silver ecosystem and reshape how price discovery unfolds going forward. A $9 premium is not a minor pricing anomaly. It is a loud market signal. In global commodity trading, premiums of this magnitude rarely appear without a meaningful imbalance underneath. When buyers in China are consistently paying $9 above the international benchmark price for physical silver, it immediately raises a fundamental question. Why is local demand so strong that it justifies such a significant markup? Premiums develop when domestic supply cannot meet immediate demand at prevailing global prices. In practical terms, it means that available inventory inside the country is insufficient relative to industrial consumption, investment buying, or both. China is one of the largest consumers of silver globally, driven by its dominant position in solar panel manufacturing, electronics production, and advanced industrial fabrication. Silver is not merely a store of value in this context, it is a strategic industrial input. When manufacturers require uninterrupted supply chains, they are often willing to absorb higher acquisition costs to secure material. A sustained $9 premium also suggests logistical or structural constraints. Import channels, refining capacity, or exchange inventory levels may be under pressure. When domestic buyers cannot source enough metal internally, they must attract supply from international markets. The premium acts as an incentive mechanism, encouraging global traders and bullion dealers to redirect shipments toward the higher-priced region. This is how arbitrage begins to reshape global flows. From a financial perspective, persistent regional premiums highlight fragmentation in what is often assumed to be a unified global pricing system. The benchmark spot price represents a reference point, but it does not always capture real-time physical tightness in specific markets. When the gap widens to $9, it reflects urgency in procurement. It also indicates that physical silver in that market holds more immediate utility than the paper benchmark implies. For investors and analysts, such a premium cannot be dismissed as temporary noise without evidence. If it persists, it signals durable demand strength and potentially tightening global availability. Markets reprice when sustained imbalances become undeniable. A premium of this size is not just a number, it is an expression of supply stress, industrial priority, and competitive bidding power within one of the world's most influential commodity-consuming economies. When you see inventories declining in a major Western storage hub while a key Eastern market is paying a substantial premium, you are not looking at isolated events. You are looking at the early signs of global supply tightening. Commodity markets are deeply interconnected, and silver is no exception. Metal does not disappear, it moves. And when it starts moving aggressively from one region to another, it usually reflects imbalance. Global silver supply is relatively inelastic in the short term. Mine production cannot rapidly increase in response to sudden demand spikes. Bringing new mining capacity online requires years of capital investment, permitting, and development. Recycling flows can fluctuate, but they are also limited by price incentives and collection infrastructure. This means that when demand accelerates or inventories decline unexpectedly, the market cannot quickly manufacture additional supply to stabilize conditions. If physical silver continues leaving New York vaults while China maintains elevated premiums, global availability tightens mechanically. Metal flows toward the higher-priced market, reducing buffer inventories elsewhere. Those buffer inventories serve an important purpose. They absorb shocks. When they shrink, the system becomes more sensitive to disruptions. Even modest increases in industrial consumption, investment demand, or geopolitical friction can have outsized pricing effects when stockpiles are already constrained. There is also a psychological dimension. Market participants closely monitor inventory data and regional pricing discrepancies. Once traders and institutions recognize sustained tightening conditions, behavior changes. Producers may hold back sales anticipating higher prices. Consumers may accelerate purchases to secure supply before further increases. Investors may reallocate capital toward physical exposure. These feedback loops can reinforce the tightening dynamic. The key financial implication is that supply tightening often unfolds gradually before it becomes visible in headline prices. By the time benchmark prices fully adjust, much of the repositioning has already occurred. Regional premiums and vault drawdowns are early indicators, data points that reflect real-world stress before it is widely acknowledged. When global supply buffers erode and regional demand remains strong, volatility tends to increase. Silver, already known for sharper price swings compared to gold, becomes even more reactive under constrained conditions. Tight markets reward preparation and penalize complacency, especially when structural demand drivers remain intact. When a $9 regional premium appears in a globally traded commodity, professional traders do not ignore it. They calculate it. Arbitrage is one of the most powerful forces in financial markets, and it operates with precision. If silver is priced significantly higher in one region than another, capital and inventory will attempt to close that gap. The question is not whether arbitrage will occur, but how fast and how efficiently it can be executed. In practical terms, arbitrage in the silver market involves sourcing physical metal, where it is cheaper, transporting it and selling it into the higher-priced market. On paper, this seems straightforward. In reality, it depends on logistics, financing costs, regulatory approvals, shipping timelines, refining specifications, and currency considerations. Each of these variables influences whether the $9 premium translates into a true profit opportunity after expenses. When the spread is large enough to justify those costs, traders begin reallocating supply. That movement accelerates vault outflows in lower-priced hubs such as New York. Inventories decline not randomly but strategically as metal is drawn toward the region offering the strongest return. This process redistributes global stockpiles and can intensify tightening conditions in the exporting region. There is also a capital flow dimension. Financial institutions financing bullion trades may increase credit lines to support physical shipments. Hedge funds and commodity desks may deploy short-term capital to capture the spread. As more participants engage, the arbitrage window can narrow, but if underlying demand remains strong, the premium may persist despite these flows. That persistence signals that structural demand is overpowering temporary supply adjustments. Currency dynamics further complicate the equation. Exchange rate fluctuations between the US dollar and the Chinese yuan can either enhance or compress arbitrage margins. Interest rates also matter because holding physical silver carries opportunity costs. Professional participants evaluate all of these factors before committing capital. If arbitrage flows intensify, they create second-order effects. Western inventories shrink faster, liquidity tightens, and market sentiment shifts. What begins as a regional price discrepancy can evolve into a global rebalancing of supply. When price gaps remain wide despite active arbitrage, it indicates that demand pressure is durable and that the market may be undergoing a deeper structural adjustment. Here is where the silver market becomes even more complex and more compelling. Silver is not driven by a single demand engine. It sits at the intersection of industrial necessity and investment psychology. When both forces begin operating strongly at the same time, pressure builds in ways that are not always immediately visible in headline prices. China's role is central in this equation. As one of the world's largest manufacturing economies, its consumption of silver extends far beyond bullion investment. Silver is a critical component in photovoltaic solar panels, semiconductors, medical devices, electric vehicles, and advanced electronics. These are not optional sectors. They are strategic industries tied to long-term industrial policy and global energy transition goals. When industrial production expands, silver demand follows with mechanical consistency. Industrial demand behaves differently from investment demand. Manufacturers do not typically attempt to time the market perfectly. Their priority is supply continuity, not price speculation. If silver is required for production lines, procurement teams focus on securing volume first and managing cost second. That urgency can justify paying significant premiums, particularly when supply chains are tight. A $9 premium in this context may reflect operational necessity rather than speculative enthusiasm. Now consider the investment side. During periods of macroeconomic uncertainty, inflation concerns, currency volatility, or geopolitical tension, silver also attracts capital as a tangible asset. Unlike industrial buyers, investors may accelerate purchases when they anticipate future price appreciation. When industrial and investment demand rise simultaneously, the competition for available physical supply intensifies. This dual demand structure makes silver inherently more volatile than metals driven primarily by one demand category. Industrial cycles can be strong even when investor sentiment is cautious and vice versa, but when both align, inventories can decline rapidly, and regional premiums can expand. The financial implication is straightforward but powerful. Markets that serve both strategic industrial needs and defensive investment motives are more sensitive to supply constraints. If China's industrial consumption remains firm while investors globally increase physical allocation, the strain on inventories becomes structural rather than temporary. In that environment, price stability becomes harder to maintain, and the margin for supply disruptions narrows significantly. Step back for a moment and look at the broader macro environment. When physical silver leaves major Western vaults while large consumers are willing to pay aggressive premiums, it rarely happens in isolation. It often reflects a deeper shift in capital positioning. Investors and institutions do not reallocate toward tangible assets without reason. They do so when confidence in financial conditions, currency stability, or policy direction begins to adjust. Silver has historically functioned as both an industrial input and a monetary hedge. In periods of elevated inflation, expansionary monetary policy, or rising sovereign debt levels, hard assets tend to attract renewed attention. The appeal is not theoretical, it is practical. Physical metals carry no counterparty risk. They do not depend on the solvency of a financial intermediary. When systemic uncertainty rises, that characteristic becomes increasingly valuable. Strategic asset repositioning can occur quietly at first. Institutional portfolios may increase allocations to commodities as part of broader diversification strategies. Sovereign entities may seek to strengthen reserve assets. Family offices and high net worth investors may shift a portion of capital from purely financial instruments into physical holdings. These adjustments are rarely announced publicly, but they appear indirectly in inventory data, vault withdrawals, and regional pricing dislocations. Interest rate policy also plays a critical role. When real yields decline or remain volatile, the opportunity cost of holding non-yielding assets like silver decreases. At the same time, concerns about long-term currency purchasing power can strengthen the case for tangible stores of value. If market participants believe that monetary conditions will remain unstable or that fiscal pressures are building, reallocations toward metals can accelerate. Geopolitical dynamics further reinforce this behavior. Trade tensions, sanctions regimes, and supply chain fragmentation encourage countries and corporations to secure strategic materials directly, rather than rely entirely on global just-in-time systems. Physical control becomes a priority. When these macro forces align, physical demand strengthens beyond routine industrial cycles. Inventory drawdowns and sustained regional premiums become visible expressions of a broader strategic shift. In that environment, silver is no longer viewed solely as a tradable commodity, but increasingly as a critical asset within evolving global financial architecture. The silver market is sending clear signals through inventory drawdowns, regional premiums, and shifting global flows. Physical movement always speaks louder than paper pricing. When major vaults see accelerating outflows and global demand centers are willing to pay well above benchmark rates, it reflects tightening conditions that cannot be ignored. For investors and market participants, understanding these physical dynamics is essential, because in commodities, supply realities eventually shape price realities. The question now is not whether the market is changing, but how prepared you are for what comes next.